Good morning, everybody. My name is David Jennings, Chairman of Movers and Shakers. Welcome to our BT Forum event this morning in collaboration with JLL. Thank you all very much for joining us. Now, JLL have produced an important and timely report which provides some fascinating insights into the fastest growing sector in UK real estate, BTR. Now, with occupational demand evolving, new models emerging, asset value models developing, and new players entering the market, investors' appetites for this sector continues to grow. As you'll hear, BTR has performed extraordinarily well during the pandemic, and in my opinion, is showing all the signs of a market that's about to move into its next stage of evolution. Or is it? This morning is a sum of three parts. Part one, we're going to have a report overview and key findings by James Kingdom, Associate Director, Living Capital Markets at JLL. And he'll provide us with an insight into the report and talk around some of the conclusions. Part two, we have a JLL expert panel session. What does it mean to the market? We bring together key players from the residential and capital markets team at JLL to discuss the implications of the report's conclusions and what it means to the BTR market, its growth, its investment, valuation, demand, etc. Now, the panel comprises Alice Smith-Hilliard, Associate Director, Living Capital Markets, who can give us the investment perspective. Matthew Green, Head of Residential Development and Valuation, who'll give us a valuation perspective. Sam Winard, National Director, Residential Agency, who'll give us that lettings and marketing perspective. And then James Kingdom, who'll be joining the session to talk about the implications of the report with his colleagues. In part three, panel three, what does it mean to funders and operators? Moderated by Simon Scott, Lead Director, Living Capital Markets at JLL. He'll be joined by Guy Herwood, Investment Director at Moda Living. He'll give us an investor and operator perspective. Rebecca Taylor, Managing Director, BTR Long Harbour, who'll also give us an investor and operator perspective. And Erin Clark, Relationship Director, Structured Property Finance at Investec Bank, will give us a banking financial perspective. Now, please remember to take full advantage of this opportunity to ask questions and feel free to share your thoughts. If you go to the live discussion tab on the BTR platform, you can ask questions, you can chat, and we'll do our best to get through any questions that you raise. You can also download the report on the platform by going to the information box, which should be on the left-hand side of your screens. But if you have trouble getting it, just drop us an email and we'll get it through to you. So let's get things underway. I'm now going to hand you over to James Kingdom, who authored the report, who will present its key findings. James, well, welcome. Over to you.
Thank you, David, and good morning, everyone. As David mentioned, we've recently published our reports on the UK build-to-rent market. So I'm going to give you an overview of some of the key points this morning before we head into the discussion sessions. I'll run through this one fairly quickly then. We've seen a 50% increase in the number of build-to-rent units built each year over the course of the last 5 years since build-to-rent was identified as an asset class in its own right. Obviously, the pandemic had an impact last year in terms of the delivery of new units. It stalled somewhat because of social distancing and the lockdown measures. However, we anticipate the delivery of new supply to return back to trend this year. In fact, anyone has seen the headlines from the Molly report for the London market that came through first thing this morning. We'll see that there's been a strong bounce back in terms of new schemes started and completed over the course of the past 3 months. With regards to how much of a role build-to-rent can take in terms of market share, well, if you look at the United States, currently multifamily and has a saturation of about 12% of the total private rented sector. A greater share as a percentage of the number of new build units in the UK market each year. Moving on to this slide, another thing we've also seen is a big increase in the amount of investments entering the sector. Last year was a record year at over £6 billion, and so far in H1 we've seen over £3 billion invested. Now, where that makes build-to-rent the largest of the living sectors in terms of total funds committed, but where it differs to say somewhere like sectors such as student housing, which is more mature and more evolved, and annual investment volumes average around about £3.5 billion per annum. The difference we're seeing with build to rent is that the majority of deals still continue to be forward funding and development focused. The number of opportunities for stabilised and income producing assets are limited. Although we have seen through the sale of purchase last year of Dolphin Square, and also the likes of, to a certain extent, ECE's purchase of the Dandara portfolio, and also Quadrial's purchase of the Uncle platform, more stabilised assets starting to come through. So as a sector evolves, that income producing element will continue to increase, but compared to more established sectors, we're still some way behind. And this trend is reflective really of a wider change that we're seeing across the investment markets. Investors are continually putting much greater attention onto the bedded sectors that form living, and that's largely because there's a certain degree of defensive quality within these sectors. They're very strongly linked to demographics and structural change, and less affected by economic and financial cycles in the same way as retail and offices are to a similar extent. On that basis, we've seen throughout the last 18 months, we've seen occupancy levels have remained fairly robust, as has rent collection figures, and obviously the residential sector was one of the first to come out of be removed from the RICS's special measures criteria due to the impacts of the pandemic. So encouraging sign there. And one of the main reasons why investors are so keen to get into the living sectors is there's a significant supply and demand imbalance. There's going to be over 4.5 million more people living in the UK's urban areas over the course of this decade. And obviously, for the last 20 years, we've been building below the annual housing target in terms of new homes being delivered. So there's also obvious imbalance there. But at the same time, that supply-demand imbalance is one of the main reasons for we're not seeing more capital being deployed into these markets because of the limited number of opportunities that are available compared to investor demand. One of the main drivers, obviously, for what distinguishes a Grade A product is obviously the location, but also to take into consideration is the quality of the build. But one of the key determining factors is also the level and the scale of amenity provision. You can see for a Grade A product, the typical number of range of amenities on offer is quite extensive, and obviously in many cases the differentiation between a Class A and a Class B product is purely down to the location. In fact, there are a good number of examples of schemes that are defined as Class B down to where they're situated, but offer a Grade A level of amenity provision. A very good example of that would be Black Horse Mills in Walthamstow, where you've got the swimming pool, tennis court, large amounts of leisure space for the residents, as well as co-working facilities, and also very strong level of support for residents in terms of their well-being, but also it's Home Quality Mark 1 assessed building, and also Gold Wide score in terms of its broadband and internet provision. You'll see that the focus on development is very much aimed towards A and B. Class C product is typically legacy stock, a mixture of office to residential conversions and some of the more historic elements of some of the portfolios in the market. And it's no great surprise that the level of development in that particular bracket is dropping off. So as a share of the market, that will drop off over the course of the coming years. And then moving on to this slide. A lot of the debate so far has been around about the fact that multifamily is a product primarily for young people, and particularly in urban areas. And I mentioned the fact that we're going to have 4.5 million people living in the UK's urban areas over the course of the next decade. But that definition of urban area also includes towns and suburban areas as well. So it may be a surprise to some of you, but the largest increase in households in the private rented sector over the course of the last decade has actually been amongst people with children. And that explains partly why we're seeing a much greater emphasis now on single family housing. We've seen already the likes of Legal & General, Lloyds through their Citra platform, and obviously Present Made with Apache as well, starting to make inroads into this particular aspect of the market. And it's a trend that we're seeing being reflected stateside as well, with the likes of Investec and BlackRock are being very active in terms of acquiring single family housing, whether that's in mass from developers or individual assets in suitable suburbs via the housing market. But the telling trend that we've seen also is the fact that the largest proportion of households are actually over the age of 35 in the private rented sector. So high-rise, high-density apartments in city centres are not the overall solution for this particular market. There's a lot more flexibility in terms of products and the range and offer that needs to be provided to potential customers. And lastly, one of the main drivers for why we see build to rent is going to continue to grow and become more popular is due to affordability and the value that it offers. Now, over the last decade or so, rent as a proportion of monthly income has averaged around about 32-33%, compared to 18% for mortgage payments. But the biggest obstacle for people getting onto the housing ladder in the UK at present is the general affordability that we're seeing from decades of house price growth and decades of undersupply in terms of new build housing. Now, obviously, there's been steps made with Help to Buy, and obviously at the moment we've got 95% mortgages available. But if you look at the house price to earnings ratio across the UK, it's every single London borough, the ratio is in double figures. I think it's 55% of all local authorities in England have an HPE higher than the national average, and 91% of local authorities have got a house price to earnings ratio higher than 5, which is the threshold for HSBC's loan to value ratios for their mortgages for anyone earning less than £100,000 per annum. So it is a major obstacle in terms of people getting to the market or getting onto the housing ladder. So that's where Build to Rent offers a ready-made solution. Now we've seen over the course of the last 10 years or so, rents in the wider private rented sector have pretty much tracked earnings growth. And obviously, what we've got to take into account at the moment is the fact that we're living in a much higher inflationary environment. House price growth this year has been incredibly strong and will continue to be so. And in the wake of the inflationary pressures that people are seeing on their pay packet, things are being more expensive. Energy costs are rising significantly, and there's more taxes being applied to people's salaries as well. To help pay for the pandemic and things such as social care, that in terms of value for money and affordability, being in the private rented sector, and in particular BTR, offers a lot more value for money. If there's a prospective tenant, you had a choice between an apartment in the private rented sector or build to rent. Yes, you might be paying slightly more for the one on the build to rent, but you'll be getting something that's higher quality, is purpose built, and has a broad range of amenity provision available to you. But importantly, now one thing that's going to shape people's perceptions is also the fact that your bills are typically inclusive as well. So if you take into account the rising electricity costs that we're going to see over the course of the coming months, that's going to have a real implications on people's decision-making process. And it's just another one of the pull factors and the perceived value for money that Build to Rent is going to offer prospective tenants and customers. And on top of that, you've got the fact that you've got dedicated space to work and exercise as well in a number of these schemes, which you don't have readily available if you're buying or if you're renting straight off the broader market. So a number of things that we anticipate are going to help encourage people and promote the value of build to rent over the rider PRS over the course of the coming years and decade. On that, I will hand back over to you, David, so we can start the panel discussion. Thank you.
Thank you very much indeed, James. And I hope for everybody that those technical glitches didn't mar an excellent presentation, James, and some great content. Just a couple of things before I introduce the panel. The point about, investors coming in, significant demand and outstripping supply, which is a factor, isn't it? And that piece around the sort of grading we'll pick up on, and also the piece around multifamily, shouldn't say this, but versus single family as a derivative of build to rent. And that end slide about affordability and social mobility is a fascinating one. So look, we're now going to move to our panel session, our panel of JLL experts. What does it mean to the market? So we've got Alice Smith-Hilliard, who I introduced earlier, Matthew Green, Sam Winwood, and James obviously here. So Alice, can I start with you, if I may, please? And some of this we picked up as we went through that report, but the report points some powerful stats around the growth of the sector, and I'm going to quote a couple. 59% of investors plan to increase their exposure to the sector, which is a point I made a moment ago. In 2020, 40% of all assets traded were income producing, with a reference that forward funding continues to be the easiest way to enter the market at present. So Alice, my question to you is, how would you segment the market, and what types of investors are prepared to take and share development risks?
Yeah, absolutely. I think the stat that 40% of the investment market last year was by way of income producing deals is a really interesting one, and actually is really positive for the sector. It shows a degree of growth and depth that we're progressing in the market now, and something that we hope to see continue as we get more and more operational units come to the UK. I do think last year was a little bit of an anomaly in a sense. James refers to a few of those deals being, a couple Quadrail Real Stars Project Harmony deal, as well as AXA's Dolphin Square. So a couple of those really large deals that were income producing by nature, I think have slightly skewed that stat. And I think whilst we will see the quantum and number of income producing deals to grow as we move forward in the next few years, I think we'll first see a little bit of a dip back to a much higher weighting towards forward funding deals. And I think that's pretty evident sort of from deals done year to date this year. And I think to your point about investors and whether they're willing to, do income producing or forward funding style deals, I think that's also just a result of supply and demand imbalance in the sector. And I think it's probably fair to say that income producing deals would be high on the priority list for many investors and high on the preference sheet because of the lower risk that's associated with those. But in reality, we haven't quite got that depth of the market, even though it's growing, to allow investors to solely focus on those style of deals. And for investors that are still seeking to invest into the UK and enter for the first time at scale or expand current exposure at scale, really the mass of the opportunity still lies within forward funding opportunities. And the track record of those style and structured deals in the market to date has provided a little bit of comfort. And the structure behind them with, that back end bullet payment really does reduce a lot of that development risk. So investors are.
But is there can you point to sort of different types? Are there different sort of types of investors that have, for example, those that conversely have a preference for those income producing assets? Does it tend to be the overseas investors that will go for something that's income producing to enter a market? Is there a way of sort of segmenting the two?
It's difficult to answer because I think that typically overseas investors who had previously invested in sort of commercial, more traditional, mature sectors, they sort of seek in those markets more core plus assets, and that would lend itself very much more to income producing deals by nature. However, I think that's the initial strategy of many that come over to the UK who are new to the market. And once they start to learn more and more about the opportunities that are there, really they start to become more and more comfortable with the way that funding deals are structured. And there are different types. You've got forward funding and forward commits that does reduce the risk slightly in different ways. So I think you start to see a bit of a shift in that sense.
And typically between those two positions, so income producing versus forward funding, what's the sort of yield variation? Can you peel? I know it varies from scheme to scheme, but broadly, is there what's the difference between the two?
Yeah, broadly, we've always, as a market, adopted a 25 to 50 basis points spread between funding yields to income producing. In the past, where there was a lack of income producing deals, that was relatively unsupported, and it was based on sort of risk, the risk nature of reduced risk of income producing deals. But obviously, over the past couple of years, those transactions that have taken place that are stabilised in nature has really supported that view. And I think the other metric that goes alongside the yields is the discount to open market value. And actually, with there being greater competition for income producing assets, and where on funding deals you'd expect a higher discount to that open market value, that discount does come in when you start talking about stabilised assets, with there being less development risk, and almost investors willing to pay on parity now.
Okay, that's helpful. So in terms of, and James picked up on Class A, the high end, the high quality end, purpose built assets, good locations, top end amenities versus Class B, which was sort of the next level down. Is there a variation in terms of, I won't say investor interest, more in terms of yields at that end, or is it really about income streams?
Yeah, I'd say it's tricky because I think with the grades, there are multiple factors that go into it that basically club it together into particular grade A, B, or C. And whilst I think it's quite easy to say, okay, you have a superior scheme that's grade A, that's higher quality with much more amenity provision, I think there's other factors that really affect the yield profile of that. And, you know, if you've got a grade A fantastic product that's in a location that's got a lot of competition, it's got other grade A stock around it and a supply pipeline coming through, that income stream then is actually a little bit more risky and not as stable as perhaps a grade B scheme that might on the surface look inferior, but is very much suited to its demographical environment and a much safer income stream. So you'd actually probably look at that more favourably and more value efficient. Okay,
that's really helpful. Thank you, Alice, for the moment. I'm going to turn to Matthew now to get sort of, if you like, the valuation perspective. And again, starting off with a stat, Matthew, according to the report, throughout 2020, multifamily occupancy averaged 91%, with rent collection at 95%, which, whichever way you look at it, is pretty impressive, isn't it? So perhaps linked to this performance, the report points to a shift from the way I read it, a vacant possession breakup valuation to one based more around income. I just wondered where you thought, it's a bit the holy grail really, isn't it? Where you thought we were on that trend?
Yeah, I mean, well, in the last 10 years, the market's moved from more simplistic kind of investment appraisals towards, you know, an explicit income approach to valuation, which is very much driven by institutional buyers with that longer term outlook. So that's an income approach is already, you know, the primary approach in the UK. We've come a long way so far, but you know, as you're talking about, on the flip side of that, the BTR market is still in its relative infancy by comparison to other sectors, that, you know, including the traditional resi market. So breakup is still used as an important underwrite for pricing, but you know, there's lots of factors to consider there: legal and planning requirements, scale, lot size, affordability in the area relative to income levels, suitability of the scheme for the for sale market, and so on. But from a valuation point of view, where there's a difference between breakup value and investment value, it needs to be fully explainable, particularly if investment value is close to or possibly even marginally ahead of breakup value. But just coming back to the performance point, you mentioned you know, how multifamily's done in 2020, but as the market expands and with more operational data available, it's likely the market, in our view, will place, you know, less weight on that aggregate VP underwrite, whilst DCF or discounted cash flow models and income capitalization, they'll remain very much center stage.
Yeah, and that sort of links in quite nicely to what I want to ask you next, really, which is, you know, there's been a lot of talk, and we've both collaborated, Movers and Shakers and JLL, I think we're on about a 6th or 7th or 8th BTR forum in London, and there's always been a challenge around the need for more data on income and returns, alongside a greater openness and transparency, which again is picked up on what I think is an excellent report. So I just wondered where you thought we were on this sort of the data transparency journey. I mean, are we actually making any headway?
Data's king, as you're highlighting, and we're getting there. Is the answer to that question. As we've mentioned elsewhere, published data on rent collection and occupancy. That's demonstrated the resilience of BTR to the world through the height of a pandemic, and with more schemes now operational than ever. The data's there. It's just not always readily available in the public domain. But certainly the wealth of data, let's just talk about operational costs for a moment. That the wealth of data in that area, that's increased dramatically in the last few years, with lots of schemes under management generating consistent evidence. And that's an incredibly positive development for valuations, for appraisals, which, you're talking about OPEX, that can now be fully benchmarked against comparable buildings. But, there isn't a central database that provides market intel. So it can be harder work, for example, for a new entrant to the UK market who maybe doesn't have that direct UK experience. Obviously, it's important to get a knowledgeable advisor on board, but global investors, global advisors are also bringing knowledge, experience and data from more established multifamily markets. So there's much that we can learn from that data, and at JLL we absolutely do. But probably the last thing I'd mention on that point is there isn't a comprehensive index to benchmark purpose-designed BTR performance yet, but that will change in the not too distant future. So I guess what I'm saying is that we're moving in the right direction, but it's going to take time to build up the volume of data so that we can really start referring back to longer term trends.
Yeah, I suppose that the final question leading on from that then is assuming that we do make this shift, and we do get to a position where we can provide more data, and we move much more to a sort of an income-based valuation. I just wondered how much of an impact you think that would have on the investability, if there is such a word as investability, if not, I made one up, of BTR in the UK. Do you think that's something that would have a massive impact, particularly with overseas investors? Because I sort of sense that particularly those that are used to investing in the States must come over, and it must be a real challenge getting their heads around the market over here from an investment point of view, for the very reasons you just outlined.
Yeah, I think I understand that point. I mean, some investors might regard the UK focus on breakup value as a bit of an unnecessary complication, but yeah. I'd say that it's more likely that any hesitation to invest so far has been for other reasons, like the lack of opportunity or stock, or heaven forbid, don't shoot me, frustrations with the UK planning system.
Can't believe you said that.
I'll run away now. What we're talking about is a steady, organic change in mindset rather than a sudden shift, because investors are attracted to BTR because of its other underlying investment credentials, the opportunities for long-term growth, the housing supply shortage, affordability issues, or incomes that haven't kept up with housing inflation. Like the list could go on. It is probably worth mentioning debt here, because as the market matures, it's likely that lenders will actually gain greater visibility and confidence in the performance of BTR as building owners reach out for leverage more than they have in the past, and we're seeing that trend now. So it's probable we will see an increase in lender appetite and activity, particularly from those lenders that have either held back from the sector or haven't had the opportunity, or otherwise maybe couldn't compete with some of the terms offered by overseas funders. But just going full circle, coming back to your question, I'd say it's a more of a natural progression. It's probably a symptom of a maturing and expanding market rather than something that will release pent-up capital in itself. Okay. But your last point there, if the approach in the UK does start to align more with other established overseas multifamily markets, it will make investment into the UK more straightforward for global investors. So that's a good thing, and that's a good thing for investment flows.
Yeah. Matthew, thank you for the moment. Sam, turning to you, and Sam's going to give us a market perspective. Again, let me pick up on the report. There's some really, for me, striking stats in the report on occupier demand. The number of households in this tenure, and I think we touched on it a minute ago in the presentation, private renting has increased by 93% in the last 15 years, whilst in contrast, owner-occupier households have grown by just 3% over the same period. There is a lot of evidence of a shift in demand from millennials now in their 40s to a wider spread of groups and families. So I just wondered how you would, and James went somewhere along it, how you'd sum up the sort of, if you like, the evolution in demand for BTR from a sort of demographics perspective.
Yeah, well, I think we echo what James is saying from a on the ground point of view. So we're definitely seeing diversification of demographic. We're obviously used to hearing about young professionals in build to rent. That's the term that's always bandied about. But in reality, what we actually see is that the schemes we manage have communities that kind of reflect a wider cross section of society. There's a much greater proportion of families and downsizing retirees living in our schemes now than ever before. So we are actually seeing that happening. And also the average age of our residents is creeping up. Over the last 5 years, it's continually crept up, which again reflects what James is saying in the report. And I think, with the long-term shift towards private renting in the UK, obviously I expect that trend to continue. And as the build to rent market matures, I think what I expect to see is that we'll have more schemes being designed to appeal specifically to the growing sub-demographics. And we've seen a little bit of that in the market, but certainly that's, if you look at the more mature markets like America, that's what you see there, where you've got specific schemes targeting those sub-demographics.
Yeah, interesting. And again, a point was picked up on earlier, but there's a lot of focus. The last build to rent forum we did back in June, we had a lot of debate around single family housing, which the next big thing. But the ONS data referenced in the report predicts a further 4.4 million people living in urban areas by 2030. So I just wondered how you saw the multifamily market developing, and how you see demand across those two different products.
Yeah, I think both urban and single family living have a huge part to play in the build to rent market. So I think we've seen with recent upward pressure on the rents, it's highlighted that the strong level of demand across both the urban and suburban markets. And I think going back to the point around changing demographics as well, I think the trend towards renting for longer will inevitably mean that renters are more reliant on the private rented sector for a greater proportion of their lifetime. And so what we'll probably see is that the private rented sector will have to meet their changing requirements over that period. And I think you can see how that would mean that there would be a movement between urban and suburban locations throughout that life cycle.
Yeah, and just a final question for you. Then I've got a couple I want to ask from the audience. But from a lettings perspective, has the criteria against which a typical renter customer would choose a property changed? Have the fundamentals changed? What are they now?
Yeah, I mean, they definitely have. I think, we're realistic that we recognise that people's lifestyles have shifted completely. So there's a fundamental change in their lifestyles, which means there's a fundamental change in what they need and want from their property as well. And these changes are long term. So, we know we've surveyed our residents, asking them questions about working from home, for example, and we know that around 50% of our residents in our schemes right now expect to be working from home 2 to 3 days a week going forwards, on a long-term basis. And so what that's done is put an emphasis on things like high-speed internet, which is now a top priority, rather than maybe a nice to have previously. And obviously space to work from home. And when we say space to work from home, the interesting thing is when we surveyed our residents to find out how they wanted to work from home, actually overwhelmingly they wanted to work in some sort of communal co-working space rather than in their apartments, or a mix of both, but predominantly in co-working space. And so that's then steering how we're looking at amenities, what we're providing on site, obviously what's coming through the pipeline, and thinking about what we're designing and building in. And then maybe the other thing to add in there as well is the outdoor space. And people are less picky about how the outdoor space is provided. It doesn't necessarily need to be private terraces. It can be communal again, or even if there's close proximity to quality public spaces as well. But it's still a top of the list item as well.
Yeah, that's really helpful. Thank you very much for that. I'm going to go quickly to James, and we've sort of run over a bit of time, so I'm going to try and sort of shorten this down. I'm going to take a couple of questions, but James, what I found fascinating in the report was the reference to consolidation of the market, and for me, I don't know whether you agree with this. It seems to me, but I've thought this before, that the market's at a bit of a watershed, and it's about to make that transition, to the next stage of its evolution, if you like. And you reference the student housing sector in the report as one that is far more consolidated, if that's the right way of putting it, than BTR. How do you see that panning out, and where do you see the timing on that happening?
It takes time. Rome wasn't built in a day. You need to have that scale, and the number of units there and platforms need to be available. Student market in the last two years, we've seen 2 transactions that have totaled over £5 billion. And so, and one of those accounted for 75% of that. So it's something that will happen in due course, but we need to have the stock and the variety to do it. So it will take time, but it will certainly happen. And I think from the lesson we learned with student is the number of different types of entrants who have come into the sector. Is there'll be a few surprises. There'll be some names that you wouldn't expect. There'll be some names that you thought, well, why aren't they in there sooner? Or that makes sense. And there'll be lots of moving. We'll see assets that shift around, move across, change label. But by the same token, the overall volume of amount of investment that goes into the sector will increase undoubtedly. But you need the product to do so.
And a very quick question, as the sort of the principal author of the report, what was the sort of most striking thing, having sort of stopped and looked at the market, and it is a comprehensive report, what was sort of most striking thing for you in that report, or surprise maybe?
I think as a sector we've moved on from the days you can't just take a check every quarter and be done with it. There needs to be something extra, and with the distinction we get with build to rent is the amenity provision, the amount of things on offer. Sam just talked obviously about some of the stuff that's available and what residents want, and obviously well-being is now an important part of residents, and the fact we call them residents, not customers, as well. So if build to rent is to keep that distinction between the PRS and have that premium and that those classifications and that quality, then it's that overall package, and it's the fact that you are looking after residents' needs, you're providing a much better service. And so as a potential resident, if I'm looking at option A, build to rent, option B, private rented sector, the pull factors for build to rent will be so strong that your focus goes off the wider PRS, because you haven't got all these things in place for you. You haven't got that support. You're liable for your own utilities and things like that. You haven't got high quality broadband, BT sports subscriptions, things like that. All these things are now being offered. Dog walking services, childcare. There's everything is there. And from an operational perspective, you don't need to have a room that provides every single one of these. It's a floor space that can be flexible. You can use it in different ways. A co-working space can be a cinema room, can be a restaurant, can be a drinks terrace. You can community events. You can do so many things with a room or an area. You don't have to individually package each one up and have them taking up unnecessary space and too much cost. So it's just the quality of life, and obviously with ESG coming up, sustainability issues as well. There's a number of things where you can make the sectors going much more attractive to potential customers.
Right, I'm going to ask 2 very quick questions from the audience. question from the audience: Is the UK occupier market similar enough to the US market to be able to use its data to make predictions? I think we sort of almost answered that earlier, but does anybody want to come back on that? Is that a no?
Well, I would say for my last chart, which showed the index different cost measures, there's always been an argument that actually rent follows GDP much more closely than it does inflation. And obviously over the course of 2020, we saw a very strong drop off in GDP, but rents held firm, as did occupancy. And that's because we had obviously furlough in place, and lots of people were able to work from home. In the States, you don't have that same kind of support from the state level. And also
We've lost you. We've lost you again there. Okay. One final question for those that can still have volume on the system, and that's a question around, with the anticipated reduction in funding to local authorities across the UK for housing, do we see BTR stepping in to support families more broadly on lower incomes? And who wants to answer that one?
I can pick it up to start with. I think that's definitely a massive growth area for the investment sector, particularly in build to rent. I think that whilst we've got these gradings in place defining the current market, at the moment and in the growth phase that we've had so far, it's the build to rent market has been seen as a bit more of a premium. With the highly amenitized product. I think a massive growth area will be in providing good quality, professionally managed rental products, but across the whole of the affordability spectrum. Those types of schemes won't include the same amount of amenities perhaps, but the same level of institutional management and professional management that it will really help to solve the whole of the affordability spectrum.
Yeah, and we're seeing people like L&G and that, the last couple of years really coming to that market and seems to be fundable. Listen, we've run out of time. That was brilliant. Thank you very much, Alice, James, Sam and Matthew. We're now going to move to part 3, our final session. What do the implications of the report mean to funders and operators? Moderated by Simon Scott, Lead Director, Living Capital Markets at JLL. We have Guy Herwood of Moda, Rebecca Taylor of Long Harbour, and Erin Clark of Investec. Welcome, Simon, the panel. Over to you, Simon.
Thanks, David. Good morning, everyone. I guess I'd really like to start just sort of hearing around that sort of evolution of the build to rent space in asking Guy and Rebecca really as sort of leading protagonists within the space, what you think a good build to rent asset actually looks like by way of scale and amenity. Rebecca, perhaps if you'd like to kick off.
Yeah, sure. Morning, everybody. I think what a good build to rent asset looks like to me is something that is specifically designed for the market that it's in. So I think when we started the build to rent originally and we were looking to the US to see what they were doing, it was almost an accountancy investing to build to rent. I love that term, where if there was a tick box to kind of having all of the amenities, then surely that must be right. I think understanding the customer in a specific location, understanding the price point, and then delivering the right amenity for that is what, and I don't think there's any fixed formula. So that's probably not a helpful answer, but I don't think there's any fixed formula. I think we still need to look at everything in the round, and it's not just down to the amenity and how many square feet you're providing. It's about the quality of the apartments, the size of the apartments, the fit out of all of the spaces, and then the rental level that you're promoting and what is included in that rent. And I think the kind of misnomer of premium rents and premium product hasn't done as well in the sector necessarily, because I think it's been misconstrued by people who don't understand what that means. But I think now we're all talking about the cost of living rather than just true rent, which is, I think, another evolution.
Yeah, thanks, Rebecca. Guy, I guess this sort of point around hitting a certain point in the market is something that Moda, as Rebecca's alluded to, has often been associated with a level of amenity that obviously we're very familiar with in the stateside market. But I guess understanding why you very much targeted that side of the market to start with, and whether, I guess, as you're seeing these assets that are sort of coming to life, so to speak, with things like Angel Gardens and the Lexington at Liverpool, whether that's reinforced or made you challenge some of those decisions that were made earlier on?
Yeah, absolutely. And I think I would echo what Rebecca said about the market. I think for us, you're absolutely right. We've really focused on our resident experience, and we work with those residents to create sort of, excellent places to enhance their experience and enable them to benefit from all the amenities that we offer. I would say I absolutely agree. I think it's really important that the range of products across the market at attainable rents for the full breadth of demand across the sector. I think there's huge growth there. And I think that the report really echoes that. I suppose in terms of the success of the strategy that we've pursued today with the assets we've got, I think the demand from customers has been extremely high. We're fully stabilised on Angel Gardens in Manchester, Lexington, in Liverpool. We're at 60% let a month after opening, and all the pre-listings on that was through social media. So we're finding great engagement from our customers with our offer, and there is a huge amount of demand there. But I suspect, as the report suggests, that the strength of demand across the market is there as well, and frankly, there's not enough product yet in the market to demonstrate that.
Guy, I think I'm just going to take that point up now. I mean, I've been hearing from various operators out in the market some absolutely stellar stories about let up, particularly as the sort of country opened up. So you're saying with the Lexington, you've effectively almost done that off plan. Again, I've sort of been hearing there's obviously this sort of common held belief that you sell 1 unit a week, you let 1 unit a day. But some of the numbers I've been hearing coming out of lots of regional locations in particular have been almost triple that in some instances. Is that very much what you found in Liverpool?
Yeah, absolutely. I mean, we were 40% pre-let on opening. As I say, a month later, we're now 60%. So absolutely, I think there's really strong demand there, and certainly, our experience is echoed by other participants in the market. I think the demand is very strong. I think the focus on quality and the focus on amenity is increasingly important to residents, and I think people are prepared to as we move out of the last 18 months of the COVID situation, I think people are really focusing on their quality of life. And as we all know, as we said, people spending more time at home, the offer of a highly amenitized building with co-working space and a community, and importantly, I think that community is more relevant than it ever has been, and we're very conscious about the interactions of our customers with each other and the creation of that. I think people put more value on that than they ever have done before, and we expect that to continue.
Yeah, Guy, thank you. And Rebecca, I think you were saying you brought a couple of assets online. Similar experience for you in terms of that sort of demand profile?
We've definitely seen a two-tiered approach. So I think everybody's acknowledged that London's probably been a little bit sluggish compared to the regional markets. The regional markets, we let a building down in Kent, and the same thing, we're 60% let without any pre-lets in the first 5 weeks. So that kind of blew everybody away. And that was at rents that we underwrote back in kind of 2018 time. London's it's been sluggish, but it's certainly not been slow. So we launched our building in Tottenham. It's actually not even officially launched. We don't launch until next month. And we've achieved 70 lets in kind of 6 weeks. So the interesting thing there is the conversion rate. So we've got 94.2% of people who see the asset that sign up within 2 days in terms of that. So the conversion rate, I think that shows people are kind of voting with their feet, and they are really valuing the quality against other build to rent stock and obviously the PRS, which we talked about before. There is a real differentiation coming through now. So
some great stories in terms of sort of proving that quality of the product. Erin, turning to you from a sort of debt perspective, obviously there's a huge amount of equity trying to get allocated into the build to rent space, as James has highlighted, and the growth of the sector. But obviously over time, I guess the importance of sort of bringing some debt into the equation, and I guess particularly on the development side at the moment. I guess from a banking perspective, obviously we've heard from Guy and Rebecca about the great demand from the consumer base. But in terms of what does good look like, putting aside obviously counterparty risk, but in terms of the asset, what are you looking for in terms of a good build to rent asset?
So I think our interests are sort of pretty well aligned to the sort of the equities on this kind of thing. So sort of taking aside sort of the financial standing of the counterparty that we're going to be funding, and looking at the quality of the contractor and all of that kind of stuff, we're pretty keen on drilling down into a market and looking at the supply and demand and the sort of availability of the population that there will be to go into this kind of kit. To that extent, we're sort of, it's quite important to us looking at how those units are priced and making sure we're sort of the view, or share the view, that there's enough, a proportion of the population that's got, an income to sort of stomach some of these schemes where there is a premium that's being charged for sort of all the amenity space. I think one of the challenge, I don't know if we'll come on to this a little bit in more detail, but sort of one of the challenges that we've had funding development for a while is really understanding the exit. And that's been, I think, quite tough for probably a lot of lenders in this sector. It's becoming much easier now, as we've sort of talked about, the trading numbers are there, the sort of the occupancy and the sort of rental growth has really been demonstrated, and we can kind of buy into the story now. But there's, I think, probably still a long way to go with it in terms of educating credit boards.
So this point around transparency and the data coming through is still critical from the bank's perspective in terms of demonstrating what you're actually investing into or supporting from a funding perspective. That, in your mind, is still not as well advanced. I guess experiences in student, which is 20, 25 years potentially ahead of where we are in UK build to rent, where you've done a huge amount of work. I guess that just gives you that little bit more confidence.
Yeah, I think, to be sort of fair to sort of credit boards that will be looking at, a massive array of deals on a sort of weekly basis, from, fund finance or industrial, fund building sheds, to sort of move into a, this operational real estate class and really sort of get under it and sort of buy the proposition, in terms of sort of looking at loan sizing, part is obviously based on a, on a cost basis, and then looking at the sort of exit. And I think when we first started looking in this sector, that the sort of the business plan exit and the valuation exit were quite far apart. And as we've sort of come now and we've seen all of, a lot of those sort of assumptions actually stack up, it's much easier to sort of really support, a sort of an equity underwrite, as opposed to maybe a more conservative view that banks probably typically have taken in this space.
Yeah, and James obviously spent quite a lot of time in terms of trying to grade the different sorts of build to rent product that's coming out in the market. I guess in terms of sort of adding to the transparency, is that something you would think would be helpful from a funding perspective? And I guess, Rebecca, Guy, bearing in mind the sort of capital sources that you're working with, presumably this sort of leaning in towards perhaps some sort of hospitality gradings. Do you see that as helpful going forward in terms of differentiation, I suppose, both from an investor's perspective, but also more importantly, perhaps from a consumer perspective?
I do. I think it's going to be helpful. I mean, we have the luxury of us being a 20-year fund, or 20-year joint venture. So, we can test things out, and, don't need to necessarily think about a refi in 3 or 5 years' time. But I definitely think we will start to see the grading of amenity space coming through, or the grading of offer come through in yields. And when we start, and I think that's not just about amenity on a total per square foot basis, but I think, per apartment should be considered. But then also, I think we're going to start seeing how, impacts like ESG and kind of across the board come through into the valuation side of things as well. So I think it's not, amenity is one point, I guess. I think.
And Guy, from a sort of Moda perspective, I know obviously historically associated that sort of higher level product and specification, but I know you're very sort of mindful of that sort of broader population, as you alluded to earlier. That's an area that you're continuing to explore. Obviously saw the announcements recently about co-living, expansion into the co-living space. You're very much in line with, I think, some of the comments that were made earlier about building bespoke product for a broadening consumer base in the rental sector.
Yeah, absolutely. And I think that, I welcome grading and the more understanding and clarification is both within the industry and, really importantly, as you say, to the potential residents and the resident base we've got, to understand how that works is helpful. And as Rebecca said, I see it's an evolving, multifaceted sort of piece as to how each asset fits into it. But I think it will sort of naturally become clearer for everybody in the industry as more product comes through, to differentiate between what's appropriate for different parts of the sector. And I think James talked interestingly around, we've obviously, you've got the city centre models, which we've been delivering to date. But I think as you then look beyond those geographies as well, I think the underlying structural undersupply of rented accommodation is pretty clear. And I think that then allows you to look at what's appropriate in other locations as well. But clearly it comes back to we are still an education space in the industry, whether that's credit committees, whether that's planning officers, whether that's our customer base. I think that's probably this inflection point we talk about for our sector.
Yeah, and I think you may well have actually already answered a question that's come in from the audience around, I'll quote it directly, is the arms race for amenities over in BTR from a UK perspective? See some wry smiles there.
Yeah, I mean, I think, I think there's always, I don't know, arms race is an interesting term, isn't it? But I think in terms of, people are always, there's a healthy competition in the market to provide best-in-class assets. I think, we certainly look at it as what's appropriate. I think, not putting words in others' mouths, I think other people have expressed similar sentiments. But, I fully envisage that there will be product coming forward always that's going to be upping the bar, which, I think we all welcome and look forward to seeing what comes forward and what our customers require and look for.
Rebecca, Erin, anything to add there? No, covered that off. So I guess sort of moving on to the other area that James sort of picked up upon is, I guess, that sort of broadening of the purpose-built rental space in the form of single-family housing. Guy, I know, appreciate again that probably early days in terms of the sort of formation of strategies there, but that's certainly another area that as a group you're looking to explore to cater for that investor demand in the space.
Yeah, absolutely. I think something we've been looking at very closely, and I think it's a in terms of market fundamentals, it's a fascinating sector. Really, if you look at it from a potential supply and clear demand perspective, if you look at UK home building requirement of 300,000 per annum, if you say 20% is BTR, that's 60,000 homes a year to be built in that sector, new additional stock. And I think the report suggests there's 16,500 just under this year. There's clearly a huge structural undersupply in terms of what's being delivered today. But I think we also, if you look at it in terms of there are about 4 million rental households in the UK at the moment and growing significantly again, as the report suggests. If you draw some comparisons with the student market around potential market penetration of purpose-built BTR, you're looking at talking about 30% market share. You can see you've got, literally, 1 million plus target occupiers from existing renters. So I think the market opportunity is absolutely enormous. And I think we will, I think that, we are seeing market participants start to get into that space, and I think we'll continue with that. What I suspect will be an interesting challenge that is faced at the moment is similar to some of the issues we've talked about with where multifamily has struggled and is kind of now got to the other side, I think, to an extent around the open market sale perspective. Again, discount to open market sale, breakup values, how you underwrite the model, how you educate everybody in the sector around how that model works and what the appropriate rents are and how you value that income stream. There's all challenges that we're facing, but I do think those underlying fundamentals I've touched on are so compelling. I really expect to see that market expand significantly in the coming years.
So turning to Rebecca, obviously Long Harbour have been very focused on the multi-family element of the market. Single family on the agenda as well?
Yeah, I mean, look, one of our first investments was actually in single family. We bought a portfolio down in Kent back in 2015. So it's a sector that we know well and we've been keeping a very close eye on. As you mentioned, the new funding or the most recent funding we just raised is very much focused on multifamily, and so that's what's going to be keeping me busy for the foreseeable. But yeah, I mean, it's definitely a sector we've all been keeping an eye on for a long time. I think the interesting barriers to entry that single family is going to face at the moment is this rush to the suburban model, or for people to kind of find more space, means inevitably that capital values are going to go up. You're also in a period of construction inflation, and so I think it's going to be quite difficult for single family to get off the ground, much like it was with build to rent in the early days as well, when you're competing against that capital market or the sales market, and you're competing for the same sites. But Guy mentioned it, there's a structural undersupply of housing in this country, and it's not going away anytime soon. And so all types of tenure will do well, single family and multifamily.
Yeah. And Erin, I think James may have with the sound troubles made reference to Invesco rather than Investec funding directly into the space, but an area that you're interested in as well from a debt perspective.
Yeah, it is. We've looked at a few different schemes that have kind of come through, or sort of beginnings of iterations, and talking to clients that have got interest in going into it. I suppose we've again, there's sort of different challenges, I think, from a funding point of view, but also some kind of benefits to it. I think one of the benefits is, given if you're looking at some classic house builder sort of type product, it's easier for a banker sort of to get their head around the kind of provision of or the accommodation provision which potentially focuses less on amenity and more on the sort of square footage of the living space. I think with the bigger schemes that being phased, you can sort of rely that your income starts coming on stream at an earlier point, as opposed to sort of having the big multifamily blocks that sort of don't start and then to a particular point. I think one of the challenges though that we've sort of looked at in the past is as you move further away from the urban areas, that they are sort of, as Rebecca has said, that rental product can compete with the sales product, especially when capital values are quite a lot lower. Maybe it was a little bit more relevant when the sort of stamp duty benefits were in place, but there's sort of, again, lots of educating to be done, but I do think there's going to be a big place for it, and I'm quite keen to sort of have a look at it and keep up to date with it.
Yeah, so I guess sort of elephant in the room, which Rebecca just made reference to, and have had a couple of questions. Obviously, all of you very much exposed to the development world at the moment, and just the pressures in construction, which personally I believe are probably one of the greatest barriers to delivery at the moment, in terms of bringing some of these schemes on. I suspect the audience will be very interested to hear just where you're seeing that at the moment, just on the ground, or reference perhaps coming out of the ground and looking at schemes in the future. Erin, do you want, because I guess that's very relevant in the student space as well generally, but I guess just a sort of indication as to how you're seeing things, whether we're just on the tip of that at the moment, and how long you think that might go on for.
God, I don't know how long it'll go on for, but it's definitely having a sort of an impact at all kind of stages of the deals that we're involved in. We're looking at, a number of schemes that we're looking at the minute, having to really get under the skin of rents and, assumptions on rental growth. This is in sort of resi, all different types of market, student as well. Because with the squeeze on the costs, that's the only way to make the land values stack up. And it's just trying really to get under the skin that people aren't sort of overpaying for things and then trying to fudge appraisals to sort of make things work when that cost pressure is there. I think passing it on to contractors, it's an easy thing for bankers to ask for fixed priced contracts to be in place to take away the cost risk from our clients, but passing it on to the sort of contractors and the trades don't necessarily sort of help the situation any. So it's very tough. And I don't really know if we know what the answer to it is.
No magic wands at this point.
Not yet.
I think it's not just the construction costs either. The insurance market has gone, ridiculous. I think we've seen on one project at the moment, insurance costs across the board go up something like 167%. So yes, you're looking at construction price inflation. And then also, we've talked about amenity today, but, the staffing and the operational costs and how we service these buildings is another big cost to the actual business plan. And so, we're also seeing it on the ground, in terms of wages, people's changes and attitudes to kind of the workforce post-COVID, and then material costs in the operational side of things. So it's something that's it's not just alone in construction. I think it's across the whole border. I think it's difficult to assume that it's just going to translate into rental growth because rents are, less inelastic than sales values. But it's going to have to come from somewhere. So I think it's an interesting time in the market, especially when you're not seeing land values move at all.
Yeah, because I think I'm right in saying that neither Moda nor Long Harbour through Way of Life actually do inclusive rental packages, so they're exclusive of utilities. Is that right?
I mean, utilities, I think, I'm not sure if it's a sector-wide thing that anybody's doing. I don't know, one or two other operators are probably doing it. So, energy costs will be hitting through for us on the operational line, but not on the apartment level. I think the inclusivity of the rent from our side is about Wi-Fi, is about the service offering, and then, at the level of amenity as well, but not necessarily utilities.
Guy, that's the same from Moda's.
Yeah, it's the same. It's the same from our side. I think it's clearly that particular issue is on our agenda, looking at how we can help our residents with, given the scale of our operations as they continue to grow. It's something we're looking at in terms of ability to hedge and assist with our customers on that. But at the moment, we're utility exclusive.
Yeah, it's really interesting. Again, it feels a bit like Groundhog Day in terms of the way that the student market evolved. In terms of one moment, operators were very focused on an all-inclusive, then they went to exclusive. Package. I guess my sentiment on that is probably over time, when there is that clearer differentiation between the products and the broader private rental sector and buy-to-let offer. I think it probably gives you as operators that greater opportunity to capitalise on that exposure. But I guess early days yet.
Sorry, go. No, I was going to say something. What's interesting from our side, I think we are seeing a real customer demand for information on that. So we have a partnership with Utopia, so we track each apartment's energy usage, share that with customers and talk to them about their energy use. There's a real demand from that. I think we've got 99% of our residents currently participating in a resident sustainability program with us, where they financially contribute to that, and that's at their choice. So I think as you move into talking about kind of obviously there's a cost impact, but actually from understanding what is important to our customers, it's a really a nice thing to write up the agenda that we're working with them on and engaging with them on.
Thanks, Guy. I guess then just changing tack a little bit in terms of the sort of valuation point, which I know from a developer's perspective has always been an issue, and no doubt Matt's run to the hills for entering into this subject arena again. But I think that's a massive sea change in terms of the way that the market is maturing, in my mind, in terms of this sort of greater appreciation of these as income producing assets, and talking about the sort of balancing between aggregate vacant possession value and investment value, and even premiums too. I suspect, Erin, if I can turn to you first, from a banking perspective, that's always been an issue for you. I guess intrigued by your thoughts on those views.
It's definitely changing and sort of growing up a little bit. I was just looking at the last valuation that Matt did for us, actually, on a sort of stabilizing scheme in London, build to rent scheme in London, and we had him do 6 different valuation bases for our report. So I think traditionally, because the sort of the delta between the sort of investment value and the breakup value was quite big and quite scary for people, and trying to get their head around, again, just understanding the premise that people would trade these assets on. But again, as sort of more stuff has come through the market, and there's more operators, there's certainly more investors that are so willing to sort of buy this stuff, and that gap is now sort of closing. We are still looking at a sort of a vacant possession value, and we'll still get it, but it's quite clear that it's sort of on a sort of just for an information basis only. So it's not something that we typically use to size loans anymore. Okay. Albeit it was only a few years ago. So I think the confidence in the sort of income streams and people understanding the premiums and the benefit of sort of the the amenity space, which obviously is quite far removed from a sort of for sale product, has come on sort of leaps and bounds in the last little while.
Yeah, I guess music to your ears, Guy, Rebecca. But I guess in terms of sort of third party capital, certainly remember talking to some sort of stateside investors, and when I started making references to vacant possession value, they looked at me as if I'd just landed. So I suppose intrigued to hear sort of with your fundraising, just the views that you have from third parties in this area as well.
I mean, our 2 partners, PSP and Cadillac, are North American, so they're very much focused on investment value, but we always look at breakup value regardless. I think we still have to look at it in some way, just in terms of if yields continue to keep moving in, and you're taking on more risk as an investor. We're not just doing forward funds now. Obviously Guy and ourselves do direct development. So with that, I think we're still keeping a very close eye on VPV. But yeah, it is a good thing to see the market moving. I mean, I think it's the next step on the investment valuations, and how that moves is actually as we get more data in. The assumptions that go into that investment value as well, and not just the standard 25%, which we all know is not the right number, but still gets thrown into pretty much every appraisal. So yeah, I think it's definitely good to see that the market evolving, but there's definitely more to do.
Guy, any thoughts?
Yeah, absolutely echo that. I think as I look at it, I think it's an evolution piece, as we've said, but when you look at that performance that we were referencing during the pandemic, 91% let, 95% rent collection, I think the resilience of the income flows from these assets will continue to be proven. I rather suspect that the performance will be acyclical, much more resilient to cycles than open market sales, which I think will then, as you get more evidence and more data over time, I think that is really supportive of that. And I think 30-year DCF is probably a more appropriate way to look at it over as we evolve. But it comes back to what Matthew was saying earlier around data. We do still need more of that as we evolve, and I think that'll flow through over time.
Yeah, so sense like a real tipping point in terms of that sort of valuation approach. So I guess, again, just sort of moving on as sort of starting to come towards the end of time, I guess moving in then with COP26 round the corner, ESG, and sustainability particularly high on the agenda, and certainly something that we're hearing a lot more of from developers in the space. There's one question that came in from the audience again around the sort of appetite and desire for modern methods of construction in terms of delivery. Erin, I know you funded a number of these things. Again, intrigued by the credit committee conversations around that space and any challenges that you had in that regard.
So we just funded our first fully modular scheme, but obviously have had being involved in student for a long time, modular components of buildings previously. I think one of the biggest issues with modular and off-site construction is the security factor, and the sort of, I suppose, the flow of funds in terms of money going out the door before sort of kit is on site. I know this particular deal was sort of vertically integrated with the contractor, so that makes things a little bit easier. Slightly more terrifying when you've got some off-site sort of contractors in Morocco or different countries, and just trying to sort of get your head around how that might work, and getting things sort of to site is a little bit scary. But in terms of that one's sort of going really well. The program's absolutely flying, and I think there's huge appetite to keep looking into this into this sort of space. And I think it's just the more the sort of the more it's done and the more used to it the market gets, then hopefully that will just sort of escalate things going forward.
Thanks, Erin. Rebecca, have you sort of directly developed in the modular space to date, or?
So I think when you talk about MMC, I kind of look at it as component led, or kind of design for manufacture and assembly. And we've done that on 2 of our schemes. And, the benefit to that was, program cost certainty to our development partner at the stage. And then actually kind of the sustainability credentials, and in particular kind of airtightness and kind of those sorts of things that came through, and obviously the quality of the build. We are in the process of working on a modular scheme at the moment, which I'm sure will be in the press in the coming months. But yeah, it's something that I think is, build to rent can really align itself with modern methods, or modern methods can really align itself with build to rent, because we're focused on quality, speed, and the ESG credentials we actually value, on the long term, not just kind of in the delivery period. So I think the two, the stars should have aligned a lot sooner, I think, in the sector. But the challenges that we all know that are there, that Erin actually referred to, and actually just the amount of suppliers that are in the market. It's nice to talk about modern methods of construction, but the supply chain, is not necessarily there to deliver the volume that's required. So.
Yeah, that was another question that came in terms of the importance of that sort of contractor availability at the moment, and whether that was actually an opportunity for some of the national house builders to actually get more aligned, whereas historically perhaps they haven't with the space. Is that something
I think that's more of a question to the discount to vacant possession for those house builders, because I think they were always nervous around build to rent, or didn't see the benefit of them because their model was working. So I think that's less about the contractor supply chain and more about the direction of travel that the house builders want to take.
Yeah, I was going to ask just sort of predictions for the next 5 to 10 years, but we've actually had a number of other questions come through. So if I may, one in particular that I'm hearing a little concern about is just restrictions around the potential taxing or otherwise around the investor community acquiring assets that would otherwise go into the for sale market. Just sort of views on how that sort of nervousness might be overcome. Any views on that, Guy?
I think understanding and predicting future tax changes is always challenging. I think it's something we broadly work closely with. I think it's probably, as an industry, I think it's something that we need to ensure we're engaging with government in the right way as to the benefits of our industry. Probably flows back to the education piece we've talked about a couple of times before. And I think that is critical for, and I hope as we evolve in the sector, there will become a greater understanding and appreciation for what the build to rent sector offers UK economy and UK population, to get to a position where actually there is no there's no penal taxes on it, and it's more actually it's actively encouraged, and that's what we're working on in general terms rather than sort of specific. That goes some way to answer the thrust of the question.
Very, very much so. It's sort of educational piece in terms of what build to rent in the broader sense is actually offering to the broader market.
I have to say, I do think the BPF did a good job in lobbying the sector with the RPD hits. I think the piece of work that they did and the industry bodies coming together to help explain that, I think, that's a definite progress, with build to rent not being captured into that tax. And I mean, I think from the central government's perspective, they really should be looking at how build to rent can help on some of their agenda items, the levelling up, look at where we're all investing. It's not just London, it's nationally, the ESG kind of drivers and the alignments of the investors, and then the MMC. It seems, from central government's perspective, they really should be looking to the sector a lot more. And I think that the recent work done by the industry is hopefully started to put that in the right direction.
Yeah, I couldn't agree more, Rebecca. And I think actually that again leads really nicely into another question that's landed around the importance of the build to rent community in helping redevelop communities. Again, we have a sort of asset repositioning team within our organisation focused on some of that urban regeneration, and obviously build to rent student are major catalysts. So I guess intrigued as to whether you're seeing opportunities presenting themselves in those areas, and I suppose the challenges around mixing commercial, arts and so on in these central locations where ultimately they can be the best locations to play within for a build to rent product. Guy, do you want to kick off with that?
Yeah, no, I mean, absolutely. I think if you look at the S in ESG, I think the build to rent market generally has a real piece of land. I think we take the community, the creation of community is absolutely core to what we do as a business. And absolutely, as you say, I think, urban living, urban regeneration, the benefits to our customers of being in close proximity to all those amenities in the broader sense of what's available in that location is key. So absolutely a critical part of what we offer and how we engage.
Yeah, Rebecca, anything to add?
I mean, I think the interesting point about it comes back to the investor alignment, doesn't it? And the length of the money. If you've got people invested for a long period of time, not just in the residential, but then that brings further investment into the community. So we've all got different models. Our ground floor is always open to the public, and then the mix of uses to combine that. We're even seeing schemes at the moment with last mile logistics, which you might say aren't people friendly, but I think in urban environments is interesting. Alongside creator space and then your traditional commercial. I mean, placemaking is a long overused kind of term, but I think again the alignment, having a long-term investor in that sector, we'll start to see much more kind of mixed use places coming forward, and not just residential enclaves.
Yeah, Rebecca, thank you. And with that reference to time, I think I'm probably going to have to draw this to a head. I guess in conclusion, I guess there's a couple of words that sort of spring to mind, which is greater transparency looking forward in terms of the sector, greater engagement, both with our consumer base and government in terms of the importance that build to rent has in terms of housing supply. And from a personal perspective, more deals. So we can actually illustrate to the likes of Erin and others just how secure this marketplace is. So thank you for that all. David, there are a load more questions that I couldn't quite find enough time to. So maybe you should do another one of these forums. Over to you.
I think we should and we could. That's fantastic. Thank you very much to Guy, Rebecca, Erin, and of course Simon. I think I don't know whether you agree with me while you're on the screen. I just think it's the report that points to real underlying demand and growth and high levels of occupancy is really impressive. And it's almost like a positive, if you like, health check, isn't it, for BTR? The demand's there. You just talked about the resilience. We talked about the markets evolving. We've talked about the interesting point you guys just made about the sort of the differentiation of BTR is getting across. And I not too many years ago, Simon, I can remember us picking up on this at the BTR forum, where the market, people in the market didn't really get it. And I'm guessing if you took a cross section of the population, most wouldn't. But those that are active in the renting market in the sort of areas that we're talking about, I think are beginning to get the message and beginning to value the product. And that's really important. And we've talked about the investors lining up. So I sort of almost sense to say what could possibly go wrong. And we talked about a couple of those things, the challenge of construction inflation. I mean, really interesting this in Scotland. And I saw Alex Watts on there, who was a key player in the Scottish market. The Scottish market slowed just before we went into a lockdown because of the challenges around viability and the fact that construction costs were high, rents weren't quite there at the time, and it slowed the market right down. So those sort of marginal developments are going to be challenging, but it's coming through. And I know Scotland has started to pick up and will do very well. But listen, thank you all for your part in today, and thank you to all of the speakers who've been involved. Thank you to JLL, who are great supporters of a Build to Rent forum, and it's well appreciated. This session, by the way, everybody, has been recorded and it can be viewed on the BTR platform on demand, along with content from our recent BTR forum and previous BTR related webinars. We are coincidentally now back to delivering live events. Woohoo! The next one is in London. The new development and investment agenda, how real estate leaders are prioritising place and culture in building value. And that takes place on the 2nd of November. And we just picked up on some of their stuff. And then also this is followed by our second series of breakfast forums in the Northwest in Manchester, in the West Midlands in Birmingham, and in the Southwest in Bristol. Thank you all again for joining us today. I hope you've enjoyed the session, and I look forward to meeting you in person. Thanks very much indeed. Have a great day. Bye.